Is it a good time to buy into fear, or is it a good time to still observe this market, sitting on the sidelines? Let's discuss that with Chandresh Nigam, Head of Investments with Axis AMC. Chandresh, good morning. Thank you for joining us, Chandresh. The fall has been rather gut-wrenching. What is happening?
So I think we've seen about a 5.5%, 6% fall. I don't think it's something very large, but yes, since it is going against the grain of the sentiment, or I would say the trend in the market, especially the beginning of the year, because it was not expected, I think people have been caught a little off guard. From my perspective, I think the big rally we saw from September nearly saw about a 15 to 18% rise. And in fact a far greater rise in many of the non-frontline names. I think that is kind of getting corrected. I think if you just rewind prior to September, I think we were in a similar kind of a situation. The outlook was not very rosy. And the fact that the government started to do something on the fiscal front, some reforms, some fuel price adjustments, etc., really gave a fillip to the sentiment, and also the global flows turned quite positive. From a bottom-up perspective, I think nobody really built in very large numbers, and I think even after the budget, whatever came out, the expectation has been that FY 13-14 is going to be a consolidation year. Earnings in the mid single digits to high single digits at best. And I think whatever has happened over the last 2-3 days which we have seen on the political front, it increases uncertainty, but still doesn't change that outlook that it will be a year of consolidation. We will see inflation come off. We will see some more cuts on the interest rate side. And if the Cabinet Committee on Investment kicks in and some things happen, then we may look at some kind of a pullback or some kind of a interest in the investment demand in the second half of the year. And I think that situation kind of remains. But the euphoria on the fiscal front, the euphoria on the reforms has kind of gone away, and that's why we see this fall in the markets.
Chandresh, but how does one approach the market from an investor's point of view? Do you think the market is going to see some more weakness and downside, or is it time to start nibbling in and putting money to work?
Yeah, so I think the last time I was here on your show, I had said that if you look at the market, is essentially over the last 5 years has become like a two-stage kind of a market, or if you can look up at companies which we define as companies with pricing power, good quality, they have been continuing to grow at that 15-18% kind of growth rates, and even in a dull economic environment with GDP around the 5.5 mark, they will continue to grow at maybe about 15%. So those companies, while they look expensive on a PE basis, are likely to keep going up, maybe with some corrections, but unlikely to fall from here. And the big expectation from my perspective is that over the next 12 to 18 months, the rest of the market, which has essentially been beaten really out of shape, the companies which are more linked to the macroeconomic demand and environment in the country, that should start to see some improvement, and the market will not wait for actually seeing it in the numbers, but if the sentiment improves, we start to see investment coming back, etc., then they have a big room to move up, because valuations are probably in the single digit levels. And I think that situation kind of still remains. I would think that there is not much of a downside left in those stocks, and these levels are attractive. So while nobody can say where the markets will go short run, and maybe they can go down further, but I don't think there is a large room for markets to go down. From a 12 months to 24 months perspective, I would think these are good levels to get into quality stocks.
But quality stocks are expensive, aren't they? Banks, IT, some specific consumer names. So where is the margin of safety?
See, I think the margin of safety lies in the quality. If the quality is good and you think that these companies or businesses can grow at 15-18% for the next 3 to 5 years, you will make money. The fact is, yes, there is volatility, and maybe on a 3-month, 6-month basis, if there's a risk off or there's something more volatility in the markets, there could be a depreciation. But the fact that there are enough number of wealth creating companies out there in the market which will, let's say, grow at 15% plus over the next 5 years, I think there is significant wealth to be made in the markets. Short term, yes, there could be cases where margin of safety may not be there that much, but I think we're looking at equity as an asset class as somewhere where can people make enough money to beat inflation, etc. And I think those opportunities exist even without seeing a very large move in the broad markets.
Should that be the broader assumption now, that equity as an asset class will only beat inflation in next 2 or 3 years? It is unlikely to generate spectacular returns. We are unlikely to see a bull market.
Okay, so Nikunj, our thinking at Axis has always been that we don't talk about the market as a whole. We always look at individual companies and then they aggregate up and make the market. So if you look at it from a bottom-up perspective, I think there are enough companies which will certainly do that, albeit again we can't say on a next quarter or a 6-month basis, but certainly from a 2-year basis there are enough such companies. And as I said, if we get an inkling that the economy is really bottomed out and we go back to the 6%, 6.5% growth rate in FY 14-15, then there will be a large parts of the market, large number of companies which will respond, and investors will look out to invest in them, and these have been neglected, and so there is a significant appreciation possible. So my thinking would be that right now you stick to quality, and over the next 6 months see how the consolidation happens, how inflation comes down, and how investments start to pick up, and then you start getting into larger exposures into more of the cyclicals or the more economy sensitive companies. And I think if one sticks to the good quality in both these buckets over the next 2-3 years, there is really good amount of money to be made because valuations are in your favor.
Chandresh, in these turbulent times, would you say good quality means IT and FMCG, because those are the only two spaces wherein money is pouring in?
So I think from a good quality perspective, we mean pricing power and reasonable growth, and I think it's available across. So you can look at pharma, you can look at select agrochem, you can look at select banks as well. And I think there are the media companies. So I think there is a large gamut of companies, and that's always been the attractiveness of the Indian market, that even in tough times you will see those 50, 60, 70 companies which will just continue to grow. And and while they are restricted to some sectors, but they are still reasonably diversified, so you can have them from 5 or 7 sectors of the economy.
You're a big fan of the private banking space. If I look at a large declared portfolio, given the kind of news flow which has surfaced up for some of the key private banks, are you a bit worried here? Because everyone thought that private banks are absolute saints. I mean, they could do no wrong. But flouting KYC norms could be a serious problem for them.
So if it is really a structural and a systemic issue, then yes, it's something which needs to be fixed. However, whatever initial understanding I have of the issue, I don't think it's something really structural. Yes, the cases do point out that there might have been some lapses, but as I think it's a problem which one, I don't believe it's a really large scale problem, and two, if it's a problem, it is something which will get fixed. So yes, short run there will be issues, management time will go into addressing these issues, maybe there are some issues in relation to getting expansion, branch expansion, etc. But I don't think the basic quality of the management, the basic focus on risk management, the focus on profitable growth really goes away. And from that perspective, these remain long-term serious wealth creators in the economy, and we continue to back them.
So one stock which is really reeling under pressure is Tata Motors. It has plunged a good 5% at its lowest level since December 3. And some negative news actually coming in on JLR, especially out of China, because it seems that fuel efficiency guidelines were issued yesterday, and the new regulation aims 20% fuel economy drop from the phase 2 standard, which while we do await some more clarity, it definitely spells negative for Tata Motors. Remember, Tata Motors gets about 40% of their EBITDA out of China, which is about 20% of their JLR revenues. Tata Motors currently down by about almost 5%. Chandresh, what's the view on autos now? Because there are concerns about slowing demand, interest rates not really coming off in a hurry, so to speak. Does it seem like there are still shining stars in the auto space which have more exposure to rural India, or would you give a blanket avoid to autos right now?
So I think the short-term momentum is certainly not in favor. The local scenario is certainly weakening, both on the consumer side as well on the consumption side, as well as on the commercial side. So this will be a slow recovery, and I think, as I said earlier, 2013-14, since it's a year of consolidation, it will be the same for all across. I mean, whether it is two-wheelers, four-wheelers, even in the rural markets. So there are some pockets of the commercial vehicle space which is holding up much better. That's a very small part of the thing, but we will see some kind of a bottoming out happening, I think, whether it happens in the first half or towards the end of first half of next fiscal. And from that perspective, then see some, take a 2-year call, there may be some opportunities available. The fact is that that segments where the leaders or the companies have taken steps to be competitive and have been able to maintain some pricing power, I think there is a case for building exposure there. And some of them which are just too dependent on the economy, maybe this is not the right time to get into those.
This final question, are you a buyer on every dip, and on every dip are you buying more of the same, or you've identified some beaten down ideas after the recent price correction?
Okay. So some of our portfolios over the last couple of months, we have trimmed some of the mid-caps because we had seen some amount of enthusiasm in the markets because there was very large money flows. I think in terms of the number of quality businesses which we continue to evaluate, that remains largely the same. And so in this recent pullback, we would have added some of those names back again into the portfolio. We are not really expanding our list of investment ideas on the short run immediately, but as I said, we are on the lookout to for the economy sensitive ones, which obviously will take some more time. I think over the next 3 to 6 months, that's when we will really start to put in serious money behind those names. Otherwise, right now it's more of the same.
Sandesh, really appreciate your time and thank you for your valuable insights.